In this video, we'll be explaining how you can improve your profit-taking process by using the average daily range of a currency pair. Hi, it's Arun here from Forex, and before we begin, hit the button below to follow or subscribe so that you'll be notified every time that we release a new video. Now, the average daily range, or ADR for short, is simply an indication of how far the price of a particular currency pair moves or generally moves over the course of a 24-hour period. Now, when you are day trading currencies, then you can sometimes actually set your profit targets and your stop losses based on where the average daily range extends to. The reason why the daily range is so useful is because it gives you a very good indication of how far the pair that you're trading generally tends to move on a daily basis. Now, having that information can be tremendously helpful when it comes to either placing your trades and then obviously how to manage them in a real-time environment. Let's take a quick example. If you see a great opportunity to buy a certain currency pair, the next question is how many pips should you aim for in terms of a profit target, and then how many pips should you risk on that trade? Now, if the pair has only been moving 30 pips per day, it's unrealistic to try and aim for a 200 pip profit target. And it would also be pointless using a large 200 pip stop loss on that trade. Instead, you would want to look for profit targets within that 30 pip range. Doing this will result in your trades reaching their targets and you banking more pips on a more consistent basis. Now, once you know in what kind of range to look for in terms of profit targets or stop losses, then you can also look for key areas of support and resistance within that range where the price is likely to react from. For example, if you are buying the pair that has an ADR of 30 pips, you might notice that there is a key level of resistance or support just 20 pips away from where you entered. Now, this combination of a key technical level within the price range that the ADR gave you is a fantastic way to determine higher probability profit targets and stop losses for your intraday trades. Now, it is important not to get too carried away with using the average daily range as a firm or a very strict rule. Very often the price can and will exceed the ADR or fail to extend its full distance. Remember that it's only an average and that you shouldn't use it as a strict rule, more as a guideline. Now, you still need to have a very good fundamental reason for entering your trade, and you still also need to look for key technical levels as extra reference points. However, if you do that within your average daily range of the pair that you're trading, you're going to see much more consistent results in your trades overall. Now, if you want to see how we implement the ADR in our own trading, make sure to check out our daily video commentary or live webinars inside the Forex Source terminal.